There is a financial product that charges an annualized interest rate of somewhere between 10,000% and 17,000%. It is not offered by a payday lender operating out of a strip mall. It is not a loan shark collecting on a corner. It is offered by some of the largest, most respected, most federally insured financial institutions in the United States. And you have almost certainly paid it. It is the overdraft fee. And what looks like a $35 penalty for spending money you did not have is, when you run the actual math, one of the most aggressive interest charges in the entire American financial system, dressed up as consumer protection, sold as a courtesy, and for 2 decades, engineered with a precision that should make you furious the moment you understand what was actually happening to your account. Let's start with the basic transaction, because the number sounds almost reasonable until you look at what you are actually paying for. You have $42 in your checking account. You forget, or you miscalculate, and you spend $50 at a grocery store. You are $8 short. The bank covers the $8 and charges you $35 for the privilege. You now owe the bank $43 to resolve an $8 shortfall that lasted, in many cases, less than 24 hours. The fee on an $8 overdraft held for 1 day, annualized the way any other interest rate is annualized, is approximately 159,000%. Even if you hold the overdraft for a full week, the annualized rate is over 22,000%. Even stretched to a full month, you are looking at rates that would be illegal under most usury laws if they were called interest. But they are not called interest. They are called a fee. And that distinction is not semantic. It is the entire legal architecture that has allowed this practice to survive for decades, while payday lenders, who charge 400% annualized rates, face heavy regulation and are banned outright in several states. A payday lender charging 400% is predatory. The law says so. A bank charging 17,000% on a short-term negative balance is a checking account feature. The law says that too, and both of those things cannot be simultaneously true without someone having made a very deliberate choice about which category gets regulated. Now, let's talk about the mechanism that made overdraft fees not just profitable, but extraordinarily profitable. Because the fee itself is one part of the story. The engineering of the fee is the other part. For decades, many major American banks used a practice called high-to-low transaction reordering. Here is how it worked. Suppose on a given day you make 5 transactions. You buy coffee for $4. You pay for gas at $28. You buy groceries for $62. You pay a utility bill for $85. And you make a small purchase at a pharmacy for $11. Total spending $190. Your balance at the start of the day, $175. You are $15 short. Under a chronological processing system, the first 4 transactions clear. The pharmacy purchase triggers 1 overdraft, and you pay $135 fee. Painful, annoying, but $35. Under high-to-low reordering, the bank processes your transactions not in the order they occurred, but from largest to smallest. The $85 utility bill posts first, then the $62 grocery charge, your balance $28, then the $28 gas charge, your balance $0, then the $11 pharmacy purchase, overdraft fee number 1, $35, then the $4 coffee, overdraft fee number 2, $35, same E5 transactions, same $15 shortfall, same day. But instead of 1 overdraft fee, you have 2. Instead of $35 in fees, you owe $70. The bank processed your transactions in an order that no reasonable person would expect, and that served no purpose except to maximize the number of overdraft events in a single day. And this was not an accident of legacy software. Internal bank documents that surfaced in litigation showed that banks modeled the revenue impact of high-to-low reordering explicitly, understood that it generated significantly more overdraft fees than chronological processing, and chose to implement and maintain it as a revenue strategy. A federal judge in a 2010 case against Wells Fargo called the practice gouging and profiteering, and ordered the bank to pay $203 million in restitution to California customers. The ruling found that Wells Fargo had manipulated transaction posting order in a deliberate effort to maximize fee revenue at customers' expense. Wells Fargo was not the only bank doing this. Bank of America, JP Morgan Chase, TD Bank, US Bank, and several other major institutions faced similar litigation over the same period. The settlements ran into the hundreds of millions of dollars across the industry. And even after the litigation, the reordering practices in modified forms persisted at various institutions for years. Now, let's put the total number in context. because the scale of what this industry extracted from its least financially secure customers is staggering. Between 2000 and 2019, American banks collected an estimated $280 billion in overdraft and non-sufficient funds fees. $280 billion over 2 decades from the people least able to pay it. Because here is the demographic reality of overdraft fees that the banks understood better than anyone, because they had the data. The majority of overdraft fee revenue does not come from occasional accidental overdrafters. It comes from a small percentage of customers who overdraft repeatedly, typically between 10 and 20 times per year. The Consumer Financial Protection Bureau found that 9% of account holders generated 79% of all overdraft revenue. Those 9% are disproportionately low, income disproportionately young, disproportionately people of color, and disproportionately people who keep low balances because they have no margin for error in their finances. The banking industry's most profitable overdraft customers are people living paycheck to paycheck, who cannot afford a $35 fee, but definitely cannot afford to lose access to their checking account, which gives banks significant leverage, because the alternative to paying the overdraft fee is often worse. A bounced check can trigger a merchant fee on top of the bank fee. A returned automatic payment can cause a utility shutoff or a late payment on a loan, and losing checking account access entirely, because a bank closes an account for repeated overdrafts, can push someone into the unbanked population, where the alternatives to checking accounts are often more expensive still. The fee is extracted because the exit costs are high enough to make paying it rational. That is not a consumer protection product. That is a trap with paperwork. Now, to understand why this persisted for so long, you need to understand the regulatory history, because it is a case study in how a profitable industry manages oversight. In 2010, the Federal Reserve issued Regulation E, requiring banks to get customers to affirmatively opt in to overdraft coverage on debit card transactions and ATM withdrawals. This was a significant reform. Before Reg E, customers were automatically enrolled in overdraft programs, and many did not know they were paying for a service they had not chosen. After Reg E, overdraft fee revenue dropped meaningfully for transactions covered by the rule. But the rule did not cover checks and H transfers, which are the transactions that generate the most overdraft fee revenue. And so banks shifted their focus. They retained overdraft programs for the high-revenue transaction types. They marketed opt-in aggressively. They sent emails, letters, and in-app notifications encouraging customers to activate overdraft protection on their accounts, framing it as a safety net rather than a fee-generating product. Meanwhile, they lobbied vigorously against extending the opt-in requirement to the remaining transaction types. The Consumer Financial Protection Bureau, created in 2011 partly in response to practices like overdraft fee engineering, has been engaged in a running regulatory battle over overdraft rules ever since. It proposed a rule in late 2023 that would cap overdraft fees at $5 or require banks to treat overdraft as a loan subject to the Truth in Lending Act, requiring disclosure of the effective interest rate. The banking lobby's response was immediate, expensive, and predictable. Because the choice to disclose an annualized rate alongside the flat fee would make visible something that banks have worked very hard to keep invisible. A $35 fee sounds like a $35 fee. A loan at 17,000%. APR sounds like something that should be illegal. Same product, different framing. Enormous financial consequences. Now here is the historical parallel that provides uncomfortable context. Before the consumer finance reforms of the 20th century, loan sharking was a common and thriving industry. Lenders operating outside the formal banking system would extend small short-term loans at rates that made repayment nearly impossible, use social and sometimes physical pressure to collect, and built their business models on the recurring distress of borrowers who had no other options. State usury laws, consumer protection statutes, and federal regulations spent decades building a framework to limit these practices. The instinct behind those reforms was sound. People in financial distress are not in a position to negotiate freely, and a product that exploits that distress requires regulatory constraint. The overdraft fee, structured as it has been, fails the same ethical test that those older reform movements applied to loan sharks. It targets people with no margin. It charges rates that would be usurious if called interest. It was engineered, in documented cases, to maximize extraction. And it survived precisely because it lives inside a federally insured, congressionally lobbied, consumer-trusted institution, rather than a strip mall storefront with a neon sign. The suit and the marble lobby are very effective camouflage. So what do you actually do about this? Because the systemic problem is real, but your checking account is immediate. First, opt out of overdraft coverage on your debit card and ATM transactions if you have not already done so. Under Regulation E, banks are required to allow this for these transaction types. If your card declines at the register because your balance is too low, that is an inconvenience. It is not a $35 fee. For most people, a declined transaction is a better outcome than an overdraft fee. Second, set up balance alerts through your bank's app. Most banks will send you a text or email when your balance drops below a threshold you choose. Setting that threshold at $100 or $200 gives you a warning before you are in overdraft territory, which is infinitely cheaper than the alternative. Third, if you are charged an overdraft fee and it is not a pattern, call your bank and ask for a courtesy reversal. Banks reverse overdraft fees for customers who ask and have a decent account history far more often than they advertise. The reversal rate at some institutions is over 50% for first-time requests. They do not publicize this because the fee revenue depends on people not knowing to ask. Fourth, understand that not all banks and credit unions treat overdraft the same way. A number of online banks and credit unions have eliminated or significantly reduced overdraft fees in recent years, partly due to competitive pressure and partly due to regulatory attention. If your current institution is regularly charging you overdraft fees, the cost of switching may be significantly less than the cost of staying. And understand that the entire debate about overdraft fees is really a debate about who should bear the cost of a short-term cash shortfall. Right now, the answer is the person experiencing the shortfall, at rates they would never knowingly agree to, through a system engineered to maximize the number of events per customer. That is a policy choice the banking industry has fought very hard to preserve, and it is a policy choice that can be changed, which is why $280 billion has been spent over 2 decades ensuring that the people who could change it understand very clearly what the industry needs them to understand. So I want to hear where you land. Do you think overdraft fees are a legitimate product that provides a genuine service, and customers who do not want them can opt out or bank elsewhere? B, a predatory extraction mechanism that targets the financially vulnerable and should be capped or restructured as a disclosed loan product? Or C, a symptom of a broader problem where people living paycheck to paycheck have no good options, and overdraft is just the most visible price of that precarity? Drop your take in the comments. And the next time your bank sends you a notification encouraging you to activate overdraft protection on your account, read it again with the knowledge that the bank's most profitable customers are the ones who use that protection 15 times a year. They are not offering you a safety net. They are offering you a product, and the business model only works if you need it often enough to make $35 feel like the cost of staying afloat.